Welcome to the Stock Market Palantir. Today we are going to talk about CYPH.
We are, and this is a spectacular one. We're looking at Cypherpunk Technologies, Inc., or CYPH. This was an entity that went through, a truly extraordinary transformation back in November of 2025.
It really was. It used to be called Leap Therapeutics, LPTX, and it was, well, let's be honest, a failing biotech company. Its main asset was this controversial phase 2 drug, sirexatamab. And then, almost overnight, it pivoted into this Winklevoss-backed digital asset treasury, focusing entirely on Zcash, or ZEC.
Yeah, and pivoted is putting it mildly. The real catalyst, the explosion, happened on November 12, 2025. A press release comes out detailing a $58.88 million private placement. And $50 million of that was used right away to buy 203,775 ZEC.
And the market's reaction was just immediate. A price surge of over 550%, peaking at $3.11 just 2 days later.
Insane.
Which brings us to our central question today. Was the surge, a fundamentally driven, rational repricing by the market? Did traders just see the new assets on the balance sheet and act accordingly?
Or was it mainly a product of speculative market mechanics, algorithmic chaos, high-frequency trading, all driven by a narrative around a distressed shell company?
Exactly. I'm going to argue that the overwhelming driver here was the market's fundamental need to close an obvious, verifiable valuation gap. The mechanics were just the vehicle for that.
And I'm going to argue that while the assets provided the excuse for the trade, the sheer magnitude and velocity of it proved this was overwhelmingly a mechanical, speculative event that just hijacked the narrative.
Okay. Well, I see why you emphasize the chaos, but let me focus on the financial gravity of the situation for a moment. The way I see it, the price surge was a direct and, frankly, rational response to hard data. Before the announcement, on November 11th, LPTX closed at 43 cents a share, something like that. That gave it a market cap of about $24.8 million. And, for a failing biotech burning cash, that valuation made perfect sense.
Sure, for what it was then.
Right. But then, overnight, that entire picture just transforms. You have to look at the market basis of the assets they bought. The company's $50 million investment in ZEC, bought at $245 a coin, was already worth almost $103 million by the announcement. Why? Because the ZEC spot price had shot up to over $500.
Okay.
So you take that $103 million, you add the leftover cash, and suddenly the new liquid asset base is nearly $110 million. So when you divide that $110 million by the 56.65 million shares, you immediately establish a new quantifiable fundamental floor. And that floor is $1.94 per share. The rally from 43 cents wasn't speculation. It was the market just correcting a massive, undeniable inefficiency.
I come at it from a different way. That's a compelling argument. I get the arithmetic, and I don't deny the gap existed. But the way it closed that gap proves that any fundamental repricing was immediately hijacked by just pure mechanical chaos. The volume data is conclusive on this. This wasn't some measured correction. It was an algorithmic high-speed battle.
The volume was high. I'll grant you that.
High? It was astronomical. The evidence is it's indisputable. On November 12th, the stock traded 760 million shares. 760 million. Now compare that to a float of just about 57 million shares. That means the entire tradable equity of the company turned over 13.4 times in a single day. That level of turnover is only possible if the vast majority of trading is happening between, sophisticated high-frequency trading bots and inside dark pools. These things are driven by instantaneous volatility and momentum, not by some analyst reading a press release and doing long division. The HFT algos saw the news and just initiated this colossal high-speed arbitrage trade. They were treating the stock as pure exploitable volatility, not as a treasury vehicle.
Okay,
And let's not forget the context here, the Zongi shell context. This company had failed so badly, it had to do a 1-for-10 reverse stock split just 2 years earlier to stay on the NASDAQ. That's not just financial distress. That is a public admission of failure. It proved LPTX was a desperate and frankly perfect target for this kind of rapid, strategic takeover.
I'm not convinced that this extreme volume fundamentally negates the valuation argument, though. I acknowledge the HFT activity was tremendous, but I would argue that volume was just the market executing the move that the financial reality demanded.
But did it demand a 13x turnover?
Look, if the market were truly just chaos, the price might have settled anywhere. It could have fluctuated wildly around 80 cents or maybe $4. But it didn't. It moved aggressively toward that calculable 194 floor. And then, yes, it extended into a premium. The high volume was necessary precisely because the old market was so thin. You need massive velocity to get a stock from 40 cents to $2 when you're suddenly pricing in 110 million in new assets. The algorithms really were just the fastest way for the market to realize that fundamental truth.
I just think that line of reasoning minimizes the power of the mechanism itself. I mean, that 13.4 times turnover day is the definitive proof of mechanical dominance. I have to ask, did the fundamental realization cause the volume? Or did the volume, which drove the momentum, which triggered massive stop losses, did that create the exaggerated price move? In an HFT environment, volume often leads price, especially with a known distressed shell. And that final peak at 311, you say it's a premium for future expectations. I say it's just evidence of a speculative exhaustion point, way, way above that 194 floor. That premium was driven by pure FOMO, engineered by the volatility and the narrative hype. The Winklevoss name, the Zcash proxy, it wasn't a reasoned analysis of the assets.
That's an interesting point about the premium, though. I would frame it differently. I think the only way to justify it is to emphasize the unique financial structure here, what I'd call the dual strategy anomaly.
Okay.
CPY is unique. It's both a Zcash proxy and it retains this wholly owned subsidiary for the old cyrexanimab drug development. They even allocated $7 million to keep those biotech operations going. This structure makes the company, impossible to value with simple metrics. So investors weren't just buying Zeke. They were also buying a very high-risk venture capital-style call option on a phase 2 cancer drug. That potential, however remote, is what fundamentally justifies the premium above the 194 floor.
I'm sorry, but I just don't buy that. The retained subsidiary, it doesn't hold genuine fundamental value in this context. Leap Therapeutics was a zombie biotech. It was on the verge of collapse. They'd scrapped trials, they'd fired 75% of their workforce. The reverse split was a Hail Mary to avoid getting delisted. The company was essentially worthless.
But they kept it alive.
The $7 million allocation is cosmetic. It's window dressing. The complexity wasn't designed for optionality. It was designed to invite the very speculation we're debating. It gave institutional players a reason to categorize the stock as something other than a pure crypto vehicle, which let them get around their own compliance rules. The premium was about the narrative and the structure that enabled the trade, not the merit of a failed drug.
But if it was all narrative, why this specific shell and why Zcash? The answer has to be about the fundamental timing of the ZEC market itself.
Go on.
I mean, yes, the acquisition was brilliant corporate finance, but it also happened to coincide with Zeke hitting a 7-year high, surging over 1,400% in 2025. That parabolic ZEC rally is a massive fundamental variable, not a mechanical one. The price surge was timed, either by luck or design, to leverage the maximum possible market enthusiasm for the actual underlying asset.
That only amplifies my point. This was a manufactured event. It was a public market acquisition of a distressed shell. Retail investors and crypto communities saw it for what it was. LPTX was just a body for a Zeke proxy. It was a backdoor IPO. The price action was a consequence of that strategic maneuver, designed for maximum speed using the Zeke rally as jet fuel for the trade engine. We're looking at a system where HFT and dark pools allowed them to realize an exponential return far faster than any organic growth ever could. The value of Zeke was just the commodity that fueled the engine.
Ultimately, for me, the core driver was the dramatic and fundamental realization of that massive, verifiable valuation gap. It was created instantly
by the $110 million liquid asset base. And the market was just economically compelled to close it. The mechanics, the HFT, they simply provided the velocity needed to get there.
And I reiterate that the level of HFT activity proven by the 13.4 times float turnover shows that the price action, especially that speculative premium, was primarily a product of algorithmic volatility and intense speculation on a zombie shell. The fundamental value was just the starting pistol for the chaos that followed.
It really is a masterclass in modern finance, isn't it? A perfect collision of fundamental revaluation and speculative market mechanics. It created an entity that was sort of intentionally designed to be complex, almost unvaluable by normal metrics. And the debate remains, what was the primary engine, the quantifiable balance sheet or the market chaos that exploited it?
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.